Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 248 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today we are going to be talking about your portfolio and specifically rebalancing your investment portfolio and why you may do this, why you may not do this, and whether or not it's actually beneficial for you to do so. And so if this is a new concept for you, hopefully this is something that maybe you can take into account and employ in your investment process. If this is not something new to you, maybe you already know how you feel about it, or maybe you just kind of set the idea aside and maybe you need to pick it back up and actually employ this in your own investment life. And so I will cover all these things about rebalancing your portfolio and whether or not I think it is an appropriate step in your financial life in today's episode. So stick around for that. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, creating financial goals that are specific to you and your family's needs, and we can begin pushing towards the attaining of those goals, and then ultimately the attaining of long-term financial freedom, whatever that may look like in your own life, because that's what I want for everyone who watches or listens to the show on a day-to-day basis, that they achieve their own semblance of long-term financial freedom. So I talk a lot about investing on this show because I do think it's a very big part of our financial life, and it's something that we do need to learn a lot about. There's a lot of little concepts. There's a lot of little minutia that people need to learn about in order to be more informed investors and in order to do things in the best way possible for themselves in their financial lives. And I think that there's a real big lack of education when it comes to investing just overall. And so I try to go through these different topics on a day-to-day basis and talk about some of the little things of investing that I think are important. Now, I know that I talk a lot about picking individual stocks, investing in individual companies, different investment strategies that you can use, all these different things. But I am not naive to the fact that a lot of people don't go about buying individual stocks on a regular basis. That's not something that most people do, nor is it something that most people should do. I've said that before, that I don't think that most people should be buying individual stocks on a regular basis. They should just buy some diversified mutual funds or some index funds or something because that is first of all, it's an easier way to invest. It doesn't require as much time or research or just knowledge of financial markets, right? And it can allow you to grow your money because we all need to be growing our money for the future. So I've said this, I've made this clear. And so a lot of times we can just think it's just really straightforward if you're not investing in individual stocks. Just pour money into the mutual funds that you want to pour it into and just set it and forget it, right? Whatever percentages you want, those particular funds or, the ETFs or index funds, whatever you're using, right? Whatever percentages you want them at, you just set those percentages, you pour money into them and allow them to be allocated in those percentages. And that's that, right? Just kind of keep track of it as you go. But otherwise, your investment portfolio should be set. Now, you're not wrong, okay? But there are little things that can get out of whack in our investment portfolios, okay? And specifically, when we talk about portfolio rebalancing, which I'm talking about today, something that can get out of balance is your asset allocation, right? And when we talk about asset allocation, we're just talking about the different mixes of assets within your portfolio, okay? So, for instance, if you had 75% stocks in your portfolio and 25% bonds or bond funds in your portfolio, then you would have an asset allocation of 75-25, 75% stocks, 25% bonds. That is your asset allocation. Okay. Now, why would you need to rebalance your portfolio to keep a certain asset allocation? Well, It's really, really simple when you think about it. It's simple when you think about how your money grows. It's simple when you think about how what you're invested in grows, okay? So why is rebalancing a portfolio so important? The purpose of rebalancing a portfolio is to achieve your desired proportions of risk and return potential in your investment portfolio. When you first design and commit funds to an investment strategy, right, you are allocating your assets for the first time. Right? As a simplified example, you may want to have 70% in stocks and 30% in bonds. When you initially fund your portfolio in this manner, it would be what you considered a balanced portfolio, meaning you have exactly 70% in stocks, exactly 30% in bonds, right? And you have a portfolio that is balanced in that way. Now, the problem with this is that over time, your portfolio will 100% become unbalanced in some way, and will require some rebalancing, or many would argue it will require some rebalancing, okay? Allocations in your portfolios just don't stay the same. Just because you put 70% stocks and 30% bonds doesn't mean that you are going to keep 70% stocks and 30% bonds over time if you just let those funds ride. It's just not going to be the case, right? Really, far to the contrary, okay? If over a long period of time, let's say you have that 70-30 stock to bond allocation, right? That 70% stocks is going to far outperform those 30% in bonds over a long period of time, right? Or at least if history holds, that will be the case, okay? And if that's the case, then what's going to happen is relative to your bond allocation, your stock allocation is going to increase, right? So you're not just going to have 70% of your portfolio in stocks, you're going to have 78% of your portfolio in stocks, or 85% of your portfolios in stocks, or 90 plus over time percent of your portfolio in stocks. And then the bond allocation will subsequently be less relative to the stock allocation. Okay. Now, what that tells you is that your initial investment strategy is no longer. Right now, any money that you're putting away in this portfolio, right? Or let's say you're just not putting money away in this portfolio, you're just letting it grow, right? Any growth that you're getting from this portfolio, you have such a high percentage in stocks and such a low amount in bonds in a particular situation like this, that your risk tolerance is way out of whack, right? You may have set a 70-30 portfolio because you thought that that fit your risk profile. But obviously, as you increase the amount of stocks in your portfolio and you decrease the bond allocation of your portfolio, that is taking on more risk. It's taking on more implied volatility over the long term, and it's actually reaching for higher returns. So when your portfolio does get out of whack in that way, you may make better returns, okay, but it is not in line with your risk characteristics. And I told you before, you shouldn't invest in anything that does not meet your risk profile, right? That does not at least flirt with your risk profile, all right? We don't need to be investing in things that obviously we don't understand. We've talked about that many, many times, but you also don't need to invest in things that are more risky than what you are expecting to invest in, okay? And by just allowing your portfolio to get out of whack, to get unbalanced over time, then you are taking on more risk than is necessary, right? You are taking on more risk. So what do we do, right? What can we do? Well, we can rebalance our portfolio. Now, what does that look like, okay? Rebalancing a portfolio may look like this. Let's say that 70% allocation in stocks moves up to 80% of your portfolio being in stocks and 20% in bonds. Okay, so now you've got a little more risk on the table in your portfolio and you want to adjust that back down. Well, how would you do this? It's a pretty natural process. What you would do is you would just sell any of the investments that you had in stocks that have gone up in value. And then you would take that money and reinvest it into your bond allocation, right? Which would increase your bond allocation and subsequently decrease your stock allocation. It's going to allow you to de-risk a bit. It's going to allow you to take money from something that may be overvalued or may have grown already and put it into something that has not grown as much, right? Or maybe even something that is undervalued. Now, I'm going to get into some of the disadvantages of doing this, but something that you need to keep in mind, and something that is very, very true, is that when you do this, you are going to give up some returns. 100% you are going to give up some returns, especially over the long term. Right? When you rebalance your portfolio, you're likely to give up long-term returns. And the reason for this is that stocks are typically going to outperform bonds over a long period of time. Okay, and if you are trying to keep a certain stock bond allocation, you're always going to get out of whack in the way of stocks over a long period of time. And if you get out of whack in that particular way, again, you are likely to take on more risk. Well, more risk means more return, all else equal. Okay, but if you sell some of those winners in stocks, right, and then reinvest it into bonds, which naturally over a long period of time will make a lower rate of return than stocks will, right, then naturally you're taking money out of an asset class that has more growth potential and putting it into an asset class that has less growth potential, but possibly more stability in the money that you invested there. So there are pros and cons here, but you have to understand that the whole point is not let's make the best returns possible. The point is managing risk. Okay, the point is that you set a certain investment strategy because that's what fit you best, or you felt that that was the most suitable for you when you began investing in that way. Now, that doesn't mean that portfolio allocations don't require some adjustment over time. And if you realize that you are relatively comfortable with an 85% stock portfolio or a 90% stock portfolio, then that's perfectly fine too, right? But if you pick a 70-30 portfolio and that's what you want to maintain, over time, it's just not going to maintain itself. It's not going to stay 70-30 without you actually working, without you being active in some way to maintain that 70-30 split. Okay, now, is this huge for all investors? I don't necessarily think this is huge for all investors because most investors over a longer period of time aren't going to have large bond allocations, or maybe shouldn't have large bond allocations in their portfolio, right? If you look at most target date retirement funds, and these are, again, I've talked about these before, but a target date retirement fund is nothing more than a fund that somebody like Vanguard or Fidelity or one of the major mutual fund companies or families puts together that has some specific date at which you are set to retire, meaning some year you are set to retire, and it usually goes in increments of 5 years. And then it allocates assets in that particular portfolio based on the amount of time that you have left. And a lot of those portfolios for, like a 2065 or a 2060 or 2055, right, are currently at a 90-10 split between stocks and bonds, right? So a lot of individuals in the view of individuals who make these target date retirement funds fall into a situation where they can take a lot of risk and can be heavily invested in stocks and not need a large bond allocation. And in not needing a large bond allocation, then obviously you are going to have a lot of your returns come from the stock market, but your returns will still get out of whack, right? If you're invested in a target date retirement fund, then what you'll see is if your stocks are outperforming your bonds, then they will ultimately rebalance back to the portfolio allocation that they have set for that particular portfolio for that particular time, and your investments get shifted just a little bit. And like I said, that will cost you some return over time. But the higher your stock allocation is, the less it is going to cost you in the way of returns over time. That is just naturally going to be true. Now, you may think that rebalancing a portfolio sounds kind of weird. Like, why am I selling winners to buy losers, right? That seems like a really weird thing to do. Why am I selling winners to buy losers? Well, again, this is more of a risk thing than it is a case for maximizing returns, right? It's a case for managing your risk. And it also is only a case for allocating in different asset classes. And different asset classes are going to perform differently. Like I said, over a long period of time, stocks are going to outperform bonds, but you have to be okay with that. If you set a certain investment strategy, you need to understand that stocks are going to outperform bonds over a long period of time, and you have to be okay with that. Right? Or else you will get largely out of whack in your portfolio. And then when the market crashes, then you're going to worry where did the value of your portfolio go, right? When you got up to 90% stocks and you only wanted it to be 70%. The value of your portfolio would tank and you wouldn't know what happened, right? You wouldn't know why you took on so much risk. Well, you simply took on a lot of risk because you failed to rebalance your portfolio over time. Okay, but this should only be done in the context of different asset classes because when you are buying and selling individual stocks, right? So that's one asset class. Stocks are one asset class. And let's say somebody wants to rebalance their portfolio within the individual stocks that they own. Okay. Well, that may mean selling some winners in your portfolio in order to buy some underperformers or losers in your portfolio. Now, this isn't always wrong, right? Because sometimes you're going to get some stocks that outperform for absolutely no reason, or they outperform so greatly, right, that you need to take a little profit off the table, or they've had a real big momentum run and you want to take some profits off the table, and that's perfectly fine. And then you can reinvest in things that, in stocks particularly, that haven't had that run, that haven't taken off yet, have really good long-term prospects. So it's okay to do that in the terms of a stock portfolio within that single asset class. Okay, but the problem with doing it within that single asset class is that you can get into the habit of selling winners to buy losers, and that is going to weigh on your returns over time. Not only is that going to weigh on your returns, it doesn't really help you when it comes to risk management, right? It's very likely that you're not impacting your risk all that much at all. That's why with specific asset allocations over different asset classes, you are impacting your risk, right? And you want to adjust your risk that meets your particular risk profile. But if you're just doing it within a portfolio of stocks, you're really not impacting your risk all that much. Now, unfortunately, there's no perfect method of determining your ideal asset allocation in a balanced portfolio. One method of determining the best asset allocation for you is called the rule of 110, meaning subtract your age from 110 to determine the percentage of the portfolio that should be allocated to stocks, with the remainder mostly in bonds. Okay, so for instance, being a 25-year-old, that would mean 85% in stocks and 15% in bonds. Now, I would argue personally that there's no way I should have a 15% bond allocation. There's no way, right? That just absolutely would make no sense to me. But again, it's not perfect. There is no perfect method of determining an asset allocation. The real important thing is that you choose one that is commensurate with your risk tolerance, and then you just pour money into it and rebalance into it over time. Now, if you have like a 401k or an IRA or something, and you have multiple mutual funds that you've chosen, especially over different asset classes, right? And you're putting money into those systematically. So let's say you are putting in 70% of each month's contribution or each paycheck's contribution into a stock portfolio and 30% into a bond portfolio. So you're trying to maintain that 70-30. Well, even while you were doing that, those stock and bond portfolios can be moving in price. And again, stock portfolios are likely to outperform the bond portfolios. So if you are actively putting money into an account, rebalancing becomes less of an issue because you are maintaining with the new money the portfolio allocation that you chose at the beginning. But the problem is that you're still going to have growth and you're still going to have outperformance and underperformance. And in doing so, your portfolio is still likely to get out of whack in some way, shape, or form. Now, one big advantage that investors have when they do rebalance their portfolio, especially if we are investing for the long term, which is what I am trying to get you guys to do, is invest over a long period of time, meaning 5+ years, 10+ years, 20 years, right? Invest over a long period of time. And if you are a long-term investor, then rebalancing your portfolio can be helpful. So when market values plunge, instinct tells us to sell our holdings before conditions get worse. And when market values only seem to rise and everyone is making money, right, that's when we want to put our money into the market. This is human nature, but it's also the exact opposite of buying low and selling high. Being essentially forced to sell high and buy low, right, is one of the most significant benefits of maintaining a balanced portfolio over time. For example, if the stock market crashes and equities lose 30% of their value and the bond allocation in your portfolio is likely to become too high. Restoring balance to your portfolio could involve selling some of your bond investments and buying stocks while they're cheap. Establishing a balanced portfolio and taking steps to keep it that way can help you to avoid relying too much on emotions when making important investment decisions. So this is basically saying that if the stock market takes off and maybe is in a bubbly territory, and some may argue we're there now, right? If it's in some bubbly territory and the stock market gets overvalued, this rebalancing idea would force you to sell some of your overvalued assets and go and buy some bonds, which provides you a little more safety, a little less risk, right? But if you had some plunge in stock values, then instead of getting out of your stock allocation, instead of selling as things went down, which is the opposite of what you're supposed to do, right? Instead of selling, it would force you into selling some of your bond allocation and repurchasing some stocks, right? And that would allow you to put money into the undervalued asset class, which is valuable in that particular way. But if done in the opposite way, it can be problematic to your returns. Again, you are going to give up some returns over time just by rebalancing your portfolio. But again, it is okay because this is a risk management technique, not something that we are doing in order to maximize returns in some way. But it can help you to do so in some simple cases. Now, what may be some downsides of the rebalance, right? Why might there be some negatives to rebalancing a portfolio? The disadvantage is that now we have to ride the fine line between risk management and profit, right? Or risk management and return. Okay, so the purpose of a target allocation is risk management, but that leads to owning more of something that makes you less money, right? It leads you to buying into things that are going to make you less money over time. So consider this example with all returns remaining static. Let's say you have a $10,000 portfolio, 80% stocks, 20% bonds. So $8,000 in stocks, $2,000 in bonds. Okay. Over the year, your stocks return 10% and bonds return 4%. At the end of the year, you have $8,800 in stocks and $2,080 in bonds. The total value of your portfolio is now $10,880. You now have 81% of your portfolio value in stocks and 19% in bonds. Rebalancing says that you should sell some of that $800 profit from your stocks and use that to buy more bonds. However, if you do that, you will have more bonds that pay you 4% and less invested in those stocks that pay you 10%. If the same thing happens next year, selling stocks to buy more bonds leads to a lower total return. While in this example, the difference might be a difference of less than $100 over a year, your investment time horizon is far longer than 1 year, hopefully, right? And in most cases, it's decades. If you were to lose out on just $25 a year over 30 years at 6% interest, that's about $2,000 in losses. Bigger dollars and interest rates make the disparity even more harmful to your portfolio. Also, this example didn't consider the cost of broker commissions to buy or sell, which don't really come into play very much anymore. And it also didn't consider the tax burden on earned income that will be realized once it's sold. So this actually is a big idea that we need to hit on just momentarily. Okay, so obviously you're going to give up some return. Obviously you're going to be investing more money in something that is not making you as much money in its growth. But let's also talk about where we should be doing this. We shouldn't just be rebalancing everything that we own. Okay, it's just not smart to do so, and it's not tax efficient to do so. Okay, I'm perfectly fine with the periodic rebalance of a 401k, an IRA, some tax advantaged account. Now, why do I say tax advantaged account? Well, within a 401k or an IRA, you can trade as much as you want to, and there are no taxes on gains. There's no capital gains tax within IRAs, 401ks, whatever, because the taxes are either deferred in some traditional form of those accounts, or it's completely tax-free in the Roth versions of those accounts, okay? So you can buy and sell as much as you want, and there's not going to be any tax implication, at least not until you get to the end of the line in a traditional account, and you have to pay income tax on all money that you take out of that account. So let's just say you had a portfolio of mutual funds or ETFs or something within a taxable brokerage account, just a normal brokerage account, okay, where all of your gains are taxable. Well, that's going to discourage you from rebalancing and discourage you from rebalancing as often, right? Because any gains that you're making, it would require you to pay taxes on your gains, whether it's long-term capital gains or short-term capital gains, meaning your income tax rate, right? Either way, right, you're going to have to pay taxes on your gains when you sell, and then you'll repurchase the thing, again, that may be making you less money, Okay, and you will continue to do this, so you'll continuously be creating a taxable event for yourself, which is not the most tax efficient thing to do. So a lot of this idea of rebalancing is relegated to those tax advantaged accounts like your 401k or IRAs, right? I don't want you to be, having to pay a lot of taxes on your brokerage accounts when it's not necessary to do so. And especially when you may have some short-term gains that are going to trigger higher taxes. That's just not going to be something that's advantageous to you. Okay, I want you to pay the least in taxes possible. Okay, so anything that you have in your brokerage accounts should be within some target allocation for yourself that you would feel comfortable with over a long time, even if it got a little out of whack. Okay, so in a situation like that, I would not be rebalancing my entire investment portfolio, just the things that fall within some tax advantaged accounts. Now, do I think that you should really pay attention to what you're purchasing within a taxable brokerage account and that the things that you buy within these accounts should look very different? Absolutely. I've told you guys before that I think that anything you buy within a taxable brokerage account should be something that you would want to hold forever and ever and ever, so you don't trigger any type of gain that you would have to pay taxes on, right? It's something that you would like to hold for the long term that doesn't distribute a lot to investors, because anything that is distributed to investors in the form of interest or dividends would be taxable in some way as well, right? But within your IRAs or 401ks or whatever it is like that, if you invest in some just really nice growth mutual funds or stocks or whatever, right, and you make really big gains, you can sell and get those gains and not have to pay taxes on those gains. So that's something that you have to take into account as well. Now, the effect of the rebalance isn't limited to stocks versus bonds. Over the last 5 years, the S&P 500 has far outperformed emerging markets, with a 92.88% 5-year return on the S&P 500 compared to just 12.07 from a popular emerging markets index. Now, if you were to have sold the S&P to buy more emerging markets, it would have cost you big time over the last 5 years. Okay, and this is again, within maybe a 401k or something, right? If you have large allocations, like I think about the Dave Ramsey allocation here. He talks about 25% in international markets, right? And 25% in growth, 25% growth in income, and 25% aggressive growth. Right? Well, he's going to be giving up some returns in those aggressive growth type funds for the returns of the emerging markets, which have, again, vastly underperformed in the recent past, right? And in doing so, pull down returns of the entire portfolio, even though emerging markets as a whole are a little more risky, right? So this kind of goes against the fact that we are managing risk. And higher risk would mean higher return, because in this case, that's not necessarily what's happening. Right? So I just think specifically about his allocation in this case, and just think that if you're doing that, you are giving up return. But you have to understand, if you're going to rebalance your portfolio, understand that you're doing it for risk management reasons, not for reasons of maximizing return. You want to be able to sleep at night. You want to have an allocation that's going to be beneficial to you over a long period of time, and that's going to provide you the returns that you need with the ability to sleep, with the ability to not worry about your portfolio over a long period of time. And this is all the more important for investors who don't do research for individual stocks and don't do a lot of diving into the market on a day-to-day basis, because the less that you understand, the worse you can react if your portfolio is taking on too much risk and has a big swing downward or something like that. You want your portfolio to match your risk tolerance, so make sure that it does so. And then if you want to rebalance on a periodic basis in your tax advantage accounts, by all means do so. But just understand that you are going to give up a little bit of return just to maintain the risk levels that you were trying to maintain. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites. insights. Tell me that you are interested in financial coaching, and you and I can work together creating financial goals that are specific to your life, and we can push towards those goals together and ultimately help you to reach long-term financial freedom. So tune in tomorrow as I continue talking about personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.